Welcome back to the deep dive. Today, we're looking at an economy that, everyone calls the next great growth story India. All the signs seem to be pointing up, but our source today suggests we might need a bit of a reality check. We're digging into a really fresh analysis from Trading Post, which is an entity that's been, for years, famously bullish on the Indian market.
And that's exactly what makes this so interesting. There's this deep tension right in their findings. Trading Post is still telling clients to maintain an equity overweight on India. So they're still saying buy.
Okay.
But, and this is the key, their new report says, and I'm quoting here, that the luster has come off the growth story. So our mission for this deep dive is to unpack that. Why the skepticism? We need to get a clear look at these two pressures. One is structural, one is cyclical, that seem to be holding India back.
And the sources are great. It's a mix of big picture economic data and some really granular industry intel. They even had specific conversations with groups like NASCOM. And just to give you a sense of their dedication, the main analyst was doing all these deep dive Zoom calls because she'd broken her wrist.
That's commitment.
Yeah.
They didn't rush this reevaluation. All right, let's jump right into the biggest issue, the one that really shapes India's long-term future, what they call the AI revolution gap.
The structural constraint. So what's the big picture here?
Trading Post frames it in the context of these massive global tech supercycles. They say we're in what economists call the sixth Kondratief wave.
The sixth Kondratief wave. Okay, break that down for us.
Think of them as these huge waves of innovation that last, 45 to 60 years. They basically set the economic rules for half a century. This new one, which started around 2020, is all about AI, clean energy, and biotech.
So this isn't just about the latest gadget. The source is saying these waves literally determine whether a country succeeds for the next 40 years.
Precisely. A nation's ability to ride this wave decides if it achieves real prosperity or if it just sort of languishes.
Yeah.
And geopolitically, whichever country leads the AI revolution, well, it effectively wins the race for global economic supremacy. That's the whole U.S. versus China dynamic right now.
And so India's lag in AI is the main reason Trading Post is dialing back its enthusiasm. They see it as this binding constraint on growth. And they're arguing that AI is the difference between India just chugging along at, say, 6% growth versus hitting that much more exciting 8% plus trajectory.
Exactly. And if you look at the investment numbers, the scale of the gap is, well, it's sobering. You hear about these big pledges for India, and they sound impressive. Google, for instance, promised $15 billion over 5 years.
Right.
Microsoft, $3 billion over 2 years. And Amazon, about $12.7 billion by 2030.
Right.
The Indian government has also put in about $1.25 billion for AI.
Those are big numbers, especially when you spread them out over the next few years.
They are. But let's put it in context. Let's compare it to the big global players.
Yeah.
The 4 major U.S. hyperscalers, we're talking Amazon, Microsoft, Google, and Meta, are spending about $90 billion.
Okay, $90 billion.
Per quarter.
Wait, hang on. $90 billion every 3 months. Compared to pledges for India that are spread out over 5 or 7 years, that gap is enormous. I mean, does Trading Post's overweight recommendation even make sense then?
And that is the tension. That's why they say the luster has come off. Even if you look at China, the gap is just striking. China's state-backed VC funds have pumped roughly $912 billion into strategic industries, including AI, over the last decade. And today, China has over 4,500 AI companies and holds 60% of all AI patents filed globally. India is just miles behind on infrastructure.
But let's get to the domestic picture, what Trading Post heard on those NASCOM calls. Now, for you listening, NASCOM is India's main software and services industry association, so they have their finger on the pulse. And they are seeing some action on the ground, aren't they?
Oh, absolutely. The data shows a real surge in domestic Gen AI startups. They jumped from around 240 a year ago to over 890, projected for the first half of 2025. Cumulative funding has hit $900 million. That organic growth is a great sign.
And there's a real prize at the end of this.
A huge one. NASCOM thinks India's AI market could hit $17 billion by 2027. And that could add something like $450 to $500 billion to India's GDP by 2025 alone.
So if the opportunity is there and the startups are bubbling up, what's holding back the scaling? What are the roadblocks?
This is the critical question. The scaling challenges are severe. Trading Post flags a huge talent gap. NASCOM estimates a shortage of around 50%, one of the highest in the world. On top of that, there's a lack of regulatory clarity, which makes investors nervous, especially for deep tech. So funding is actually contracting at the early and late stages. They say there's an urgent need for big public-private co-investments to de-risk this whole area.
Okay, so that's the structural piece, the struggle to catch the AI train. Now let's shift to the cyclical problem, which honestly might be even more baffling. They call it the corporate investment puzzle.
Right. And let's start with the good news, because it's undeniably good. The economy has definitely turned a corner. It grew 7.6% year over year in the first half of 2025, mostly driven by consumption. And here's the key thing. Corporate balance sheets are really strong. They are cash-rich and not over-leveraged.
We've seen some of that data on corporate health. It looks fantastic on paper.
It's overwhelmingly positive. A major Indian credit agency, Crystal Ratings, shows broad-based strength. They have a really high upgrade rate of 14%. And just look at the debt metrics. The average interest coverage ratio is a very healthy 5.3 times.
Okay, hold on. For those of us not reading quarterly reports, what does an interest coverage ratio of 5.3 actually mean in simple terms?
It means that the average Indian company is making 5.3 times more profit than it needs just to pay the interest on its debt. It's an incredibly comfortable position to be in. They are not struggling with debt at all. Companies in infrastructure, capital goods, construction, they're thriving.
So if all the fundamentals are basically screaming, invest now, where's the spending? This is the second big problem for Trading Post, right? Profitability is up, balance sheets are healthy, demand is there, but the corporate investment cycle is down.
And it's a genuine mystery. Trading Post actually wrote that they and their contacts were none the wiser. They asked everyone they spoke to on those calls why investment hasn't turned up when conditions are this good.
But they did put together a few theories, and this is where it gets really interesting. It's less about economics and more about, well, psychology.
Exactly. The first one is practical. Some companies are just waiting for capacity utilization to get really, really high before they commit to more CapEx.
Okay, that makes sense. But the second one is much more powerful.
It is. Trading Post thinks that companies are still profoundly scarred from the last big investment supercycle. They remember decades of taking on too much debt and the painful write-offs that followed. It's like this collective corporate memory of pain is just overriding what should be an obvious opportunity.
That's a fascinating insight. You have the cash, you have the demand, you have low debt, you even have government incentives like the PLI schemes, but this sort of collective fear of the past is keeping them on the sidelines.
That's it, in a nutshell. And by comparison, the consumption story is much more solid, which is why they're keeping that overweight rating. Consumption is getting a boost from easing inflation, especially food prices. Plus, recent GST rate cuts should give a nice little lift to discretionary spending.
So Trading Post doesn't see much more help from the central bank, maybe one more small rate cut, but the consumption engine is strong enough to keep things moving.
Right. It's that cautious corporate mindset that's the difference between, say, 6.5% growth and pushing up toward 8%.
All right, let's touch quickly on the external risks, because Trading Post seems surprisingly calm about them. I'm talking specifically about trade friction, like the threatened 50% import duty on Indian exports under a potential Trump administration.
They're pretty sanguine about it, is the word they used. They're confident India could negotiate that down in bilateral talks, if it ever happened. But more importantly, the overall economic hit would be limited. Total goods exports are only about 12% of GDP, and exports just to the U.S. are only 2.2% of GDP.
So the economy has a pretty big cushion to absorb that kind of shock.
A very big cushion. In fact, Trading Post ran the numbers and found that the recent GST cuts would more than cancel out the negative financial impact of those tariffs on the wider economy.
But I assume some specific sectors would still get hit hard.
Oh, for sure. They point to diamonds, shrimp, and home textiles as the most vulnerable. Those industries have huge revenue exposure. We're talking 30 to 60% to the U.S. market. But other big sectors would only see a moderate impact.
And what about H-1B visa restrictions? That always comes up as a potential headache for India's huge IT sector.
Their assessment is that it's probably not a major negative anymore. Indian IT firms have already localized a lot of their hiring in the U.S. H-1B staff are now, a pretty small share of their workforce there, maybe 3 to 5%. And with digitization, so much of the work can just be done remotely from India anyway.
And this is where Trading Post actually finds a potential silver lining, which ties all the way back to that AI gap we started with.
Yes, exactly. They suggest these visa rules could actually trigger a partial reversal of the brain drain. You might see AI and IT specialists who were trained in the U.S. come back to India. And that influx of top-tier talent could really help close that structural AI gap and build up domestic capability.
Okay, so let's tie this all together for the listener who's watching this market. Trading Post is saying that even though India has made all these tough reforms, liberalized foreign investment, the PLIs, cutting red tape, these two big things are holding it back. The structural AI lag and the stubborn cyclical reluctance from corporations means growth is likely to just hover around, what, 6.5 to 7%.
That's their call. It's a respectable number, for sure, but it's not the explosive boom that a lot of people have been predicting. So even though the overall luster has come off, they're sticking with an overweight strategy, but a very selective one. They're focusing on sectors that tap into that strong domestic consumption story. So consumer discretionary, banks, some tech, and real estate.
And they end with this really powerful quote that I think just sums up the entire challenge. It says, "History shows India was somebody and then became nobody, and now she is trying to become someone again."
That quote just perfectly captures the ambition and the sheer weight of history here. India's future isn't just about capital or policy reforms anymore. It's about how fast it can adopt AI and, crucially, overcome these risk-averse mindsets that are keeping all that corporate cash on the sidelines. It's a battle against psychological inertia.
That is a fantastic synthesis. So for you, the listener, here's the final thought to chew on from this deep dive. If you have cash-rich companies with strong demand and low interest rates who still refuse to invest because they're afraid of what happened 10 or 20 years ago, what role does culture and collective memory play in holding back economic momentum even when every fundamental signal is green? Is the biggest barrier to explosive growth really the economy? Or is it the economic memory? We'll leave you with that.